Good morning and welcome back to the Opportunistic Trader for November 27th, a Tuesday non-expiration day. Busy fake headline night overnight. There was a fake deal at 2 in the morning and the market rallied 25 handles, and then the deal was off and we just made the low of the morning. The big headline, I guess, is Trump trying to put a 10% tariff on his own company, his own country's company, Apple. Any products made in China, 10% tax. Doesn't feel too good to do that, but overall, Apple was a crazy trade yesterday. We actually lost on it, got stopped out, could have made. Probably used too tight a stop. The month has been quiet for me and frustrating. We're almost about 50% on our winners versus losers, but it hasn't been like the first 3 months before this. So that being said, I'm joined by Vince this morning.
Good morning.
Good morning, Vince. Any thoughts overall about the markets?
Well, I mean, with so much going on with Clarita talking before the markets open, uh, I would not want to. I personally would not want to have a position going into this and be able to fade or trade with momentum if there is any. But I think it's going to be a whippy situation. And today's the type of day I would trust the type of straddle that you look at more than anything else, because it's pretty efficient. And Clarita's speaking. So many other people are speaking today and tomorrow.
You think that's really market moving?
Well, I mean, should it be market moving? No, but will it be market moving? Yeah, I think it could be market moving for this reason. Here's where my difference comes in with the market versus reality, which is I think what you're getting at. If there's an 80 to 90% chance that the Fed's going to raise in December, and that's factored into, say, Fed futures, it seems to me there's only like a 60 to 70% chance that the market thinks they're going to hike. There's hope is, destructive hope and denial, I think, drive this market. And the rally yesterday on nothing could continue if nothing extremely. I think the market is just more hope oriented than fear oriented right now, and there could be a rally to fade for no reason at all. It's a bear market rally yesterday, and I think that there's disconnect between how the market perceives Fed policy. They're slow to grasp what's going on, and versus, I think, people who pay attention more to the Fed futures and Powell's demeanor. So I think the market could move for no good reason.
Well, the market definitely will do that. I thought you were saying, or potentially saying, that we were going to get a big market move off Florida. Who
No.
think the Fed is locked in.
I do think
here.
that you could have nice whippy rate. It could be a great swing trading week. Clarita says the economy's slowing down, the market rallies 10 handles, and then she says the word "but" and the market drops 20 handles. That type of stuff. It could be good hour-to-hour trading. Definitely for range trading.
Excuse me. Sorry, I sneezed into the mic. I apologize. Yeah, I think it's going to be a good trading market. Honestly, yesterday was a very bad trading market. It, was kind of had one sell-off down to the levels where we are now, midday, and then the rest of the day it just rallied up, closed on the highs, and then Trump made this statement after the close, and the market sold off. Ironically, Apple is actually about 60 cents higher than where it was when I came in this morning. So it's I guess it's finding a level in here, and it'll be interesting to see if it can hold these levels. And overall, oil still doesn't look great. It had a up dollar day yesterday, and it's down 40 cents today. Gold's been stuck at the same place for God knows how long. So,
Russia does a land grab, and oil's bounce last 3 hours. So that should give you some insight, I guess, right?
Yeah, it bounced from. Yeah, it was down. I saw about $1.
No, I meant yesterday's rally, on the back of the whole Crimea Georgian thing. I'm not saying that that's the reason for it. I'm just saying, that should be bullish oil, but it wasn't. So it wasn't for more than $1. Let's put it that way.
Yeah. And, FANGs are all lower looking, but they're all, other than Apple, which isn't really a FANG, down less than 1%. It's funny, the S&P looks a little bit heavy, and the overall market feels not as heavy as the S&P, so it should be an interesting trade today. Yesterday, I think the NASDAQ closed up 100 and some small change, and now it's down 50. We're in interesting levels, and the market's running out of time to rally on year end. Before you know it, no one's going to do anything crazy into this weekend or into this weekend on Friday. So, the market's probably going to be in here somewhere, and there's not a lot of time. What are you expecting? Are you expecting anything out of G20? What's your thoughts on that?
Well, I think it's kind of, it threw me for a loop a little bit. Not the fact that what happened to Apple, but that Trump went bad cop going into the meeting again. And isn't he back to stage one, like what you were saying before? He's got it in his pocket. He's now threatening to do more. And I don't know. I don't understand why he would do that. I do believe this, and I can say this. I say this with pretty good confidence, speaking to people closer to the situation than me, that I think we're going to walk out of this. He has to come out with something. And elections are coming up, as you said, and China can wait. I think we're going to start hearing the word, and I really feel strongly about this. But what comes out of G20, I think we're going to start hearing the word framework of a plan, framework of a solution, which means, which is tended to be to translate as we are now really working together, and we have the framework of a solution. I really think that's going to come out of this. And
really?
I'm not the one who thinks it.
Who do you think's going to say it?
That framework is a word that works when you think about how these people talk. It sounds progressive, it's progress, but at the same time, it doesn't give you any definitives. The devil's in the details. What's the framework? We have to work on the details, but we are in agreement on many principles. And then it becomes a carve out according to industries, if you're playing the industry game. But I think the G20 comes out positive. I'm not putting all my money on that bet, but the G20 comes out positive for everything. Bearish for the dollar, positive for stocks, and positive for anything that benefits from a lower dollar, things like gold or silver or base metals. Just because the word framework, which is the logical progression of we have nothing, but we've got to escalate our rhetoric. I really think that's going to come out there. I can't say it enough times.
Really?
We have a working framework, or give me a synonym for framework. We have a sketch. We have an outline. We're coming to terms. We're getting closer. They're going to show progress.
But China's not
going to do anything except
I want to ask you this. If that's the case, China's markets have imploded. Like, why would they wait and wait and wait? Like, they just want to wait and then just do it, months after they could have done this, or, 6 months or more? Like,
well, you're kind of being devil's advocate to yourself, because we've discussed this before from both sides of the table. And why would China wait? Well, I guess they can wait because they don't have elections or real elections. That's one thing. Second thing is,
well, no, they can wait.
Point,
that was a whole different point. That was
that is a different point. Trump. But that's I'm addressing your point now.
So that's
can they afford to wait and have their markets continually be destroyed? Because their markets are like the Japanese word kuritsu for companies owning each other's shares. Their markets are like a vertical kuritsu. If the real estate collapses, then the bond market collapses, then the equities collapse more. They really, from a market perspective, can't tolerate much more of this, you would think, if they were a democracy.
But we're up and they're down, and they were down 27% on the lows this year, and they were still breathing. So if our stock market went down 27%, I would tell you that it wouldn't even be allowed.
No, I agree with you. I mean, you're kind of answering your own question. I think if you were to draw the battle lines in terms of who had strength, say you got two boxers in the ring, the strength of China is homogenous culture. They will take a beating, and they've had worse situations, and they're not a democracy. So they culturally can take more pain than we can. And the strength of the U.S. is we still have dollar as reserve currency status, and we have better financial engineers on our side manipulating markets. So it's a matter of China breaking how much can their people's backs sustain in terms of the pain versus the U.S. So U.S. down 5% is China down 30%. Like your point, well taken. And an election's coming up, and I think in 2020 something good has to come of this, even if it's not real, even if it is fake. So I think you're going to see some serious spin, and it really is a war between Chinese pain tolerance, which is higher than ours. Clearly, I mean, we could see it now, versus our ability to squeeze ancillary countries around them and make them cry uncle. All we're really doing is we're forcing those people who have close ties to us to tighten themselves to us even more with the QT, and forcing those countries that are thinking about cutting bait with us to cut bait faster. So who's in a better position to tolerate pain more than a country like China? I mean, they have a revolution like every 20 years, and I think their people are their markets may not reflect it, but they can use government controls like we can't, or at least that we can't, obviously.
I don't know. So anyway, I wanted to interrupt you because I'm getting a headline that Clarita says interest rates are much closer to neutral. So there's your big headline for the day.
Okay, so what the market?
They're going to continue the gradual approach to raising interest rates, and it should be data dependent.
Data dependent, and that's the thing. We're much closer to neutral. Then what? Than where we were 3 years ago or 3 weeks ago. The market is going to whip on that possibly, or maybe it'll do nothing, waiting for the second speaker. But Clarita, Powell, and Williams are a united front. So how do you take that? What was said, bullish or bearish or anything?
I think that they're going to raise rates in December. I think they're stuck in the corner. They can't not do it. Data is decent, and it's coming off a little, but data is decent. I think Trump ripping on them doesn't help the cause if they want to stop, because it looks like they're playing into his hand. But I actually think, and I don't know if it's bullish actually, but I actually think that they're going to only price in maybe one rate hike next year, or maybe zero, where they're looking for 2 to 3. I think they're done. I think they put a lot of pressure on the economy. They put a lot of pressure on raising rates to a very, very high level here. Now, traditionally not high, but I guess high is all relative when you're at 0 and you go to 2.5 or 3,
and the rest of the world is still negative, right?
But that's a lot different than, like, we used to always be at like 5.5, 5 and 3/4, 5.25, and we go down to 3.5, and then we go back up to 5 or 6. This is a much more, on a percentage basis, this is destructive because you're coming from 0. So that's really
that's a big problem for debt service. That's a good point.
That's the problem here.
So to your point, if I'm Powell and I'm data driven, you'll hear that a lot in their speakers, and I'm kind of backing myself into a corner, saying I'm looking at the data, and I'm going to keep raising rates. If Clarita says we're closer to normal, without saying relative to what, that can be interpreted. Powell can use that as cover, because next year if oil prices are still in this range, he can now, there's one thing he can't ignore. Lower oil prices means less inflation. And it's also a sign of an economic slowdown. That gives him legitimate cover to say, we can back off. So other than that, he has to stick to his data plan. But oil can't be ignored. And next year you could see a backing off in rates. But that's why Clarita's statement is so brilliant. We're so much closer to normal interest rate wise. Okay, relative to what? Relative to 3 months ago or 3 years ago? Does that mean we only have one rate hike, two rate hikes, three rate hikes? But I think you're right. I think you're gonna have rate hikes next year, and even if it's two, it'll be bunched up in the first half of the year, and the second half of the year will be nothing.
But we don't. You know what though? We don't know that. That's the thing that's interesting about
we don't
that.
know anything.
It's all data dependent. So if the market can hold up, listen, this is all stock market related. If the S&P can hold up, they're going to keep raising rates as much as they can.
Yesterday's rally is like Powell's cue to say, okay, we can raise rates again. The market is doing it for them,
Right, but they're going to come and raise them if they can. But talking in general, the Fed is off of zero. The Fed is off of easing. The Fed is in tightening at the minimum or neutral. There's no more free money. There's company buybacks, which, listen, I think Apple, talking about company buybacks, I think Apple is crushing their own earnings now because they're buying back stock. Their price average
managing expectations. I think there's a lot of truth to that.
Well, they're buying back stock. They're spending, last month they were spending $230 a share. Now it's $170. This is what happened in 2008, by the way. In 2008,
I mean, is this not how you do it? You say, we're not going to give you more guidance. We're not going to give you more data. And loss of confidence by analysts, other people makes them sell the stock and say, but we know what we're doing next and we're not telling you yet. Who knows what they're doing next? But, I think you're right. I think that's a great way to buy your stock.
But I'm just talking about if Apple's buying back their shares, that goes into the earnings number, okay? Because when the stock is higher, they're making more money. Well, now the stock's down 25% this quarter. Actually, this month alone, it's down 20%. The quarter, it's down over 20%. They bought stock back in the whole quarter, they're paying 20% higher. So that's got to affect what they're doing. And as the stock goes lower, they're buying more and more and more, but their price average is really not good. So we saw that in 2008. And then all the companies, if you remember, they suspended their buybacks when the market started crashing.
That is true. I'm looking for a level to buy Apple for an investment. So I'm biased, so I have to admit that up front. The fact that they're averaging.
What level are you looking at?
I'm sorry?
What level are you looking at?
I'm not looking at a level per se. I'm looking at like a price to EBITDA, or more of a fundamental thing. I want it to be defanged. I want it to be a bellwether stock with extra cash and a company that is more of a dividend throw off than anything. I don't really have a level yet. It's more like a price to earnings, but tactically, if I'm wrong, and 208 is a repeat, they're averaging in, and they maybe think they're being clever by letting the market come off while they're buying, but the snowball could be bad. If I'm right, then their earnings are going to come out in surprise because they're managing market players. I do know that they're clamping down on licensing. Like if you go out and you buy a cable for an iPhone, things they didn't used to do before they're doing now. This could be bearish. It could be bullish. I don't know. But you used to be able to go out and buy a cable for an iPhone, a third-party cable, and just plug it in and it worked. Well, now you can't with the new cable unless it has an MFI agreement, which is their licensing agreement. They're clamping down on licensing and third-party, black market or brown market stuff. So
my question to you is, I don't know what you were talking about, cables or what does that have?
I'm talking about they're more worried about cash flows from existing products than innovating. And that's what I'm seeing. And that could be good or bad, but it's bad.
Well, they haven't really been too innovative on the iPhone in the last 5 editions. I mean, the camera, they keep going, the camera's better, but I don't see any real crazy innovation. I have the new phone and it's, it's okay, but there's nothing crazy in it. The only thing was my iPhone 6 wasn't taking a charge anymore, so I think they like let them run for a shelf life, and then they basically, break the battery, or the battery stops working or whatever.
Right.
But what if, Trump is coming out and saying that he wants to tariff Apple for any 10% for any products that are made in China, which most of their components are probably made in China, I would assume.
Right.
I don't think they have really a lot of manufacturing going on in the U.S. for Apple components, but
so go ahead.
Wrong.
What if China does what?
What if they
laugh because you said it before.
No, but what if they put a tariff the same way we put it, or he's threatening to put it? What if they put it on? What if they put a 25% tariff on all goods that are coming out?
You're right. That
wrecks the company.
You made that joke. You made that as a joke before. What if they banned iPhones in China? It's the same concept. In fact,
But Trump's giving him the idea. It's almost bizarre. He's literally giving him the idea.
Right. Exactly. China's opening up shops in, just some things they could do. China would open up, shops in Vietnam. China would raise taxes on companies or tariffs on companies making parts for iPhones. Who knows? But the reality is, trade wars, currency wars don't work, and trade wars don't work either in the long run. Currency wars don't work after 6 months, and trade wars don't work after a year to 2 years. And we're not even halfway through this one. Anything we do, they can do as well. So I don't see how you win. The consumers lose on both sides. Think about what Trump said. We can handle a 10% hike. That's inflation, folks. You have a strong dollar, and yet you still have inflation because of tariffs. It's a fiscal policy that gives us inflation. So, like you said, let's see what happens if the iPhone goes with 10%, if we don't have riots in the streets.
Well, that's the exact one thing that I was going to mention before. The one interesting thing is also how off the cuff Trump goes, hey, we can handle 10%. 10% on Apple, that's significant to the U.S. consumer. That's a big hike on your annual spending, which is not that simple, and that is something important. And the other interesting thing is it's not just Apple, because if this were to actually happen, think of the fear and what this would actually do to all of technology, because most of our technology is not 100% built in the U.S. There's parts in all, countries all over the world, and what's next? They just did this to the biggest company in the entire world, or actually, as of right now, the second largest. Microsoft took them over again. What's next, sort of thing.
Right. I mean, this only gets escalating threats, not to mention the companies that create them. I mean, look at the economies of suppliers of products. I mean, tariffs down the road are just going to escalate. I don't know. Should we be buying Android phones now? I don't know. Does China make those? Maybe Trump is short Apple and long Google.
Oh, he's got the spread on.
He does.
It's just interesting that you would even bring that up, and it's just the same noise and rhetoric. And
he was actually, the clarification today, he was actually he didn't just come out of nowhere and mention this. He was actually asked a direct question, and he responded, yes, we could do a 10% sort of thing. So it wasn't like he kind of just walked out and said it. A reporter asked him specifically about Apple and said, would you consider a 10% hike or a hike? And so was also a bit of context with it.
The reporter gave him the number?
I don't think he did the number, but he said, would you consider a tariff on Apple?
Right. So then he went into a whole thing that he would do 10%. I mean, so he obviously had something in his mind.
Yeah.
Or actually, it probably was in his mind.
Well, that's the thing. Sometimes he's off the cuff. Yeah, sure. 10%, 15, 20, whatever.
He's, he's an interesting cat. That's for sure. But markets are kind of stable here. Who's trading 60, down 9 handles. NASDAQ actually is firmed since we got on the air. It's up about $12.
Well, to your point about NASDAQ, you said the S&P looked heavy compared to, say, the NASDAQ. Do you think that's a rotation, or which would be leading if you had to trade that way? Would you be a buyer of the NASDAQ or seller of the S&P?
Was leading yesterday. Today, S&P could lead. You never know. Usually on down days, Nasdaq's down more than the S&P, and on up days, Nasdaq is up more than the S&P.
Right.
Generally.
But when they diverge like this, if the Nasdaq is up and the S&P is down,
well, the Nasdaq's not up. The Nasdaq's down more on a percentage.
No, I know,
basis
but
than the S&P.
before Clarita spoke, I was just looking at. I'm seeing more and more recommendations for 2019, and I want to say this: Apple is. No one's saying sell Apple, but all the banks are now saying we recommend buy this, and no one is saying buy Apple. Sometimes you get a hold, sometimes it'll just be totally removed. So I think it's a down year for Apple, for good or bad. It could be repeated 2008, but I think allocations are going to be going towards different industries like healthcare and still some high flying FANGs. But I think Apple's just, it was, what was it? It was what's the phrase? It was Goldilocks, the best of both worlds, trades like a FANG, but solid like a bellwether. Now it's the opposite of Goldilocks right now. Right now it's neither until it gets to a certain level. So it's a bear market, I think, for everything.
Yeah, I'm not sure about that. I've been following Apple pretty much every day all year, and I could tell you that the lows were about 35 points-ish from here. And in March, we were at 150. So we went from 150 to 235 back to 170. And there's a good chance we could trade down to 150, 160 off a bad meeting this weekend, because I think that affects that stock more than any stock out there, because they're a minute away from getting tariffed, either from us or from them. So you got to be leery when you hold that position. You also got to remember, a year ago the stock was 80. Probably a year and a half or 2 years ago, the stock was 80. Couldn't catch a bid. So it's had a great run. It's interesting. Buffett is the largest shareholder.
Allegedly, still. We don't know yet.
Right. He could have blown a lot of it out, which I would say would make sense. I mean, I don't know what are they looking for that they're doing that's so innovative. They make a phone. So we'll keep an eye on Apple. Facebook had a nice rally off the lows yesterday, rallied about $5, is not giving back any of it. Again, we're negative on Facebook as a company. We don't believe that their advertising model is working the way that it should. So we're going to try to stay clear of that. Amazon is its own beast. The great. Did you see the Cyber Monday statistics? Was it like a world record again? I don't know if you saw it.
I didn't see any Cyber Monday results, but the Black Friday results were good numbers. In-store traffic was down, but that doesn't mean a whole lot because everybody's buying on their phone. The computer and phone orders were up significantly. The overall number was good, but margins are just crushed. I mean, they offer some of these products, they just mark down the levels you can't believe. And then what it also does is, as a consumer, it's like it makes it difficult to buy something in January, February when you see the price of something was just 40% lower, and now all of a sudden it's back up to normal price. But the numbers for Black Friday were good. Cyber Monday, I have not seen the exact stats, but I would assume they were pretty good based on actual dollars sold, but actual margin probably down.
But wouldn't unless it's a really bad year, the numbers pretty much always go up, because don't people either spend more money or things cost more almost every year? Like, I look at my my food shopping bill, and it's crazy. Every year the thing just goes up and up and up. So maybe the same thing goes. Obviously,
that's why the Fed's raising rates and food inflation.
There's a lot of food inflation. There's no lettuce and there's food inflation.
No lettuce.
There's only one company selling lettuce to the United States. Clearly, we have big lettuce to contend with now. I mean, the lack of diversity, you can't buy lettuce anywhere. What does that mean? Is there one company selling us lettuce or making lettuce for us? That's scary. That's like too big to fail produce.
No,
just think about that.
They cut off all romaine, regardless of what company is producing it. They said romaine.
No,
gone.
I hear
Caesar salad gone.
I hear you. What I'm getting at is there may be 3 different companies, there may be 5 different companies, but they're all getting it from the same source. It's kind of like too big to fail in the banks. there's systemic risk in Romaine now. I mean, I'm taking a concept, an analogy of globalism, and what ends up happening is you get monopolistic behavior. Too big to fail. We had 20 banks that were in trouble. Now we have 4. How many food companies are importing food? Maybe there's 4 of them. They're probably all getting it from the same source. I'm just saying, we have less diversity in choice, and that means, to Larry, I think for market purposes, the way the neo-Keynesian model works is less market risk, more systemic risk. So we put all our eggs in one basket, and the government watches it really closely. Meanwhile, they don't understand what happens when the whole system fails, because let's say like a bank like Deutsche Bank has too many derivatives, or too many people, only one company in charge of importing all the lettuce or something like that. Anyway, it's a little off topic, but I think I'm talking about market risk no longer matters, but systemic risk is. So that's what I'm getting at.
You know what the market cap at Deutsche Bank is, by the way?
Not high.
No, 20 billion.
Well, if you look at the spread between, let's call it JP Morgan and Deutsche over the past 10 years, or, a U.S. bank and, Deutsche, it's isn't pretty. Deutsche is at the lowest level, basically, since 2008. And, the U.S. banks have had a nice rebound. They still have a lot of bad stuff on the books. They're, I think Europe is trying to figure out what to do with it, as a matter of fact, because it's in the basket of too big to fail, but they've had time to kind of cope with it over the past few years, because this Deutsche is not a new story. It's been for the past few years, constantly in the headlines.
Yeah, it's just amazing. 20 billion. Like it's an odd lot, and that used to be the power bank in the 90s for sure. You'd always want to do business at Deutsche. Now no one wants to do any business there, so interesting. I know it's a side topic, but overall, looking at that bank at 20 billion, it's pretty unbelievable.
No, they definitely were involved in every part of the German economy. Hey, I just pulled up something. I want to give you an idea of like how little we should trust what we hear about what Clarita said. We're close to normal, and it's November 27th. On October 3rd, Powell said, on October 3rd, less than 2 months ago, Powell said, quote, "We're a long way from neutral on interest rates. A long way from getting rates to neutral." I mean, in 60 days, they can be a long way.
That's what a 10% sell-off in equities and a 20% sell-off in crude will do.
Right. So are you going to tell me that any organization can give you a 5-year plan, but change their opinion?
That's 2 separate people, and everybody has their own opinion. That's 2 separate people within the FOMC. And we're going to hear from Powell tomorrow, but he's definitely going to be less dovish than that. But
that's true. That's true. I don't disagree with you, but I do believe in unison, Powell, Clarita, and Williams act as one. Maybe they take soft, medium, and hard, but they're the ones that are speaking as one, even if they have different tones. Just saying, for the Fed to say we're a long way from neutral, and then well, I'll put it this way: agreeing with your point 100%, Mike. For Powell, the chairman, to say we're a long way from neutral, he's the chairman, and then for Clarita to say 2 months later we're almost at neutral, isn't that like contradicting your boss in public? Like, my point is, they discussed this, and for any organization that can flip its adjectives in 60 days, to me, is just I'm not saying that they're winging it, but they're using rhetoric to manage the markets. And
I think that we have, coming into year end, there's a lot of important things, and the FOMC, a few big things. They're going to hike in December, and then they'll see what happens after that. But the key catalyst coming into the end of the year and facing, let's call it even Q1. We have non-farm payroll. We have G20 coming up. We have non-farm payrolls. We have the Fed meeting coming up. There's a few things to kind of lead us into next year. But the key thing really for people that look long term is what's going to happen with trade. Because if there was an all-out trade war, I'm just saying if, that's something that will obviously heavily affect the economy and heavily affect the Fed's next decision. And so everybody has to take their cues from what kind of moves with Chinese growth and Chinese trade and U.S. trade. And so that's really going to be the key focus, what happens with all that. And nobody has the answers right now.
Yeah, that's pretty much spot on.
Yeah. A waiting pattern, and what Clarita says doesn't mean anything. You know, what Pal says does probably, but I'm sticking with my stance. They're going to do a raise, and then they're going to get totally out of the market because they're so freaked out with Trump and everything that they don't want to be the guy that caused the crash. And that's what Trump is setting him up to be. And that guy is not in the business of being that guy. I don't think. It's my opinion.
I think it's a good opinion, and I think
I think the guy's scared.
As one of our subscribers just put in the chat, they're raising rates so they can potentially cut in the future if need be.
Right, which is if you compare us to the rest of the world, we have bullets in the gun to lower if we have to, and we're like through an economic cycle. If the economic cycle is decreasing, let's say the economy's turned, then we have bullets to lower rates, even though it's 3%. But the rest of the world is still at 0, and they're also turning economically. So I don't see how they can catch up to us or in any way, shape, or form, considering they haven't been able to raise rates. So we're actually doing a pretty good job given circumstances. So. Yeah.
Going over the schedule for the day. So right now, S&P's down 12, Nasdaq's down 35. We're going to be open in about 20 minutes. But we have a busy schedule for the next few days. We have a lot of people speaking. So today at 11 o'clock, we're going to have Joe Vaclavec talking about ags pre-G20. Remember, ags and soybeans specifically are very dependent on what's going to happen with trade. So we're going to be speaking with him about what he's seen in the ag market and commodities as a whole. I'm actually also going to ask him about romaine, see if he's got any thoughts there. I've seen some interesting information on that. But then 12 o'clock, Adam Collins, Movement Capital, talking about the latest CO2 report. I'm interested to see what happened to energy on that one. Due to the holiday, the CO2 report actually came out a day later. So we're speaking with Adam today at noon. Then 1 o'clock today, the much anticipated new show, the Tom and Vince show. 1 o'clock, talking all things options, educating us on options, Greeks, a lot of different information. So that's going to be really interesting. Tom and Vince are going to be coming on typically 3 days a week. The time isn't fully determined. It's going to switch between 12 and 1 probably, but we'll figure that out. But today they're coming on at 1 o'clock. So that'll be some really good back and forth. Then at 2 o'clock, we are going to play. Bryn Kelly was speaking with Anthony Crudelli of Futures Radio, and we're going to play that interview. She was talking about natural gas, a lot of great information. Larry's spoken with Anthony as well, and so Anthony does a good job with that, and so we're going to play that at 2 o'clock. So 11 o'clock Joe, 12 o'clock Adam, 1 o'clock Tom and Vince, 2 o'clock Bryn, and then Larry will be chiming in throughout with market updates and things like that. But that's what we have planned for today.
All right. It seems like an exciting day here at the Op Trader. Markets are kind of quiet, so it might work well to listen in, because it doesn't look like it's going to be too busy. The big takeaway today is to see whether Apple can hold this 170, 171 level. Interesting, just a side note before we get off, the Case-Shiller number came out today, and it shows that housing prices are decreasing. It's a September number, so it's kind of late, or an earlier number than where we are now. What I'm seeing on my channel checks in New York, Connecticut, Florida, is housing prices are getting smoked. I actually had lunch yesterday with a high-end realtor, and they can't sell anything right now. So that number may be behind, but that's something to watch. And as we pointed out, for months and months and months, the home building index is down over 20% for the year. So we'll see if that has an effect on what Powell looks at on whether or not to be really hawkish and keep raising rates. But again, we do think, and this is me speaking, we do think there's going to be one hike at the end of this year, and then I think that he's going to go to a completely neutral stance, which is definitely outside the box. Maybe one raise next year, data dependent. He doesn't want to be the reason the market's going to go down next year. We will go down, and it will not be Fed related or interest rate related. It's going to be valuations and a slowdown in the economy. So those are my thoughts. That's my close, Vince. I don't know if you have anything to add.
No, except that, even though I linked the three Fed, Clarita, Powell, and Williams together, they are going to play good cop, bad cop. So if the market were to rally on Clarita says, Powell will come in and say something to knock it down. So they work as a team. For Clarita to say things like monetary policy is more art than science. I mean, what does that mean? She just said that. What do you do with that? So like you said, I think markets will correct regardless. It's a matter of how quick the descent is, and I think that's what the Fed is trying to do: control that descent one way or another.
Okay, I agree. I think it's just talk, all fake news. There'll be fake news headlines today, as there is every day. So everybody stay heads up. Be careful. Market should trade both sides today. As far as from 60, we could maybe get up to 70 or down to 50. So it's going to be a scalping kind of day. We'll hopefully be in it, making some good trades today. We need to get off the schneid and start producing here. It's been a slow month, but I guess relative to what's gone on this month, it's not so terrible.
It's better than most people. Let's put it that way.
Yeah,
just
we don't accept we don't accept that though. So we got to keep producing. Stuff looks very quiet today. So again, let's look at the straddle on the out. We'll look at the 60 straddles pricing in for 2 days only $29. So it's quiet. Usually it's about 35 to 40. Looks like a quiet day, and barring any Trump news. But we'll be back to you guys in the chat. And Vince, thanks for joining me as always, and see everybody in the chat. Thank you.
Thanks for having me.